What's going on, everyone? We got something out of the SEC that came out today. A statement on proposed money market fund reforms. So if you're not sure what a money market fund is, it's the instruments that are being used in the current reverse repo operations program from the Fed that has seen, today actually, broke the all-time record. So let's go ahead and take a look at this. Today, the Commission is once again proposing reforms for money market funds after once again observing vulnerability in these products during times of financial market stress. This time during the events in March 2020 at the beginning of the pandemic. The dash for cash that occurred at the time put severe stress on these funds and prompted federal intervention in the form of a backstop for the second time in just over a decade. It is clear that money market funds continue to raise both investor protection and market stability concerns, and while I support the success of these products, and I preliminarily support today's proposed reforms, I look forward to reviewing public comment on how best to address the complex challenges these products pose. Since their creation in the 1970s, money market funds have grown and evolved to become an integral part of wholesale funding markets. They serve a variety of roles within the financial system and are held by a broad swath of investors, businesses, nonprofits, 401k plans, and many others, like pension funds, insurance companies, and so forth. The growth and size of this asset class has been notable, expanding from roughly $2 billion in the mid-70s to roughly $4.6 trillion today. They serve as a critical source of financing to a variety of borrowers, aka the reverse repo program, aka giant share lending vehicle, and also have been large investors in the commercial paper market. These funds are generally designed to provide principal stability and liquidity and frequently serve as short-term cash management vehicles for investors. As a result, money market fund investors have been considered to be generally less tolerant than other mutual fund investors to incurring even small losses. But of course, these funds are indeed capable of incurring losses, and they suffer from inherent structural vulnerabilities. Thus, the Commission engaged in an analysis of the money market fund rules in the aftermath of the 2008 financial crisis, when the reverse primary fund broke the buck, prompting widespread redemptions and prompting the Federal Reserve to step in and create a liquidity facility to support credit supply. The 2010 reforms were largely designed to enhance liquidity and create more transparency for the public and the Commission about money market funds holdings. Those reforms were tested in March 2020 when money funds were under stress again. By that time, the Commission had completed additional reforms in 2014, subjecting the funds to valuation and risk limiting regulations, such as the requirement for institutional prime and institutional tax-exempt funds to use a floating net asset value, which means their net asset value is not constant, like the CNAV from the BlackRock funds we see in the money market. Some have a constant NAV, which means a constant net asset value of like $1. Some are liquid, they change. As uncertainty about the pandemic loomed, investors sought stability in capital preservation by moving into cash and short-term government securities. This created severe pressure in short-term funding markets, and investors sought heavy redemptions in institutional prime and tax-exempt money funds. In fact, the potential imposition of fees and gates as a result of decreases in fund liquidity appeared to fuel redemption behavior. Hence, today's proposal is a necessary continuation of our focus on addressing weaknesses of these funds and providing investors and markets with key information about them. I'd like to highlight three significant areas of today's reforms: increasing liquidity thresholds, removing the fees and gates requirement, and an obligation for certain funds to use swing pricing. They have net redemptions. I look forward to comment in each of the stress areas. Specifically, I'm interested in the foreseeable impacts of swing pricing. Will it de-incentivize first movers to help stem a run as contemplated? How might it impact investor choice? In addition, I'm pleased to see the proposal includes a requirement to notify both boards and the public when liquidity drops below certain thresholds. Broadly, the idea is not to discourage the use of liquidity in times of stress, but to offer transparency once significant amounts of liquidity have been drained. Essentially, once half of the liquidity reserves have been utilized. But is that enough? Should the Commission require reporting whenever a fund's liquidity drops below this regulatory requirements? Are investors likely to overreact to such reporting, or would the increased transparency help them make better decisions? These are just a few of my questions, and I welcome the public's views and robust data-driven analysis and comment on all of the questions in today's proposal. Finally, before I conclude my remarks today, I want to thank the staff in the Division of Investment Management, the Division of Economic and Risk Analysis, and the Office of the General Counsel, some of whom have worked on money fund reform for over a decade. You have been tireless and astutely inquisitive in developing today's recommendations. I greatly appreciate your continued dedication to develop a strong regulatory framework so that money market funds can better withstand inevitable future market stresses. Thank you. Yeah, You left a lot of shit out there, lady, but I like how you're asking the public these questions. It's because I don't know if you all know this, people. These people have no idea what's going on. They have no freaking clue what's going on. So they want the public's help and the bank's help. But you know what the banks do? They don't help. They commit more crime. Anyways, that's your statement on the proposed money market fund reforms that are coming down the pipe, supposedly. Let's see what happens.